Good morning. This is Larry McMillan with a stock market update on Monday, March 28th, before the market opens. So things are improving slightly. I wouldn't say greatly, but we're moving towards a more positive outlook. And in S&P, it's pretty clear that this rally is slowing down, but we need to see it break out over 4,600 if it's going to be a true market bottom and the next leg of a bull market. If it can't do that, then we still have some problems, and we could be in a trading range or even returning to a bear market. The support is solid down there around 4,100 to 4,200. S&P is above its 200-day moving average slightly. So those are all good things, but it's the 4,600 level that we're looking at as being quite important. Equity-only put-call ratios are solidly on buy signals. They've both fallen from extreme heights and now are below their February lows, which is a good thing. When the ratios are declining, that's positive for stocks. So this has now become one of the more bullish indicators. Breadth, on the other hand, is still floundering around. Technically, the stocks only breadth oscillator is on a buy signal, and the New York Stock Exchange breadth oscillator is on a sell signal. And that just about sums up the way breadth has been. It's just been wishy-washy. It hasn't really expanded on this rally after the first couple of days. Early it did, but then after that it has not. And so we're not counting breadth as a particularly strong indicator at all right now. Also, new 52-week highs versus new 52-week lows is in a similar situation. The real negativity has gone away, but we don't have a buy signal there yet either. In fact, on Friday, there were more new lows than new highs again. So this indicator continues to struggle to put together a positive reading. Volatility, on the other hand, has become better, although it's right on the brink of becoming much better, actually. So the VIX spike peak buy signal that's been in effect for about a month is still in effect, and at this stage, we're trailing it with trailing stops and things like that, rolling up the bull spreads, because that signal usually only lasts about a month, and we've run the month on the first signal. In addition, the 200-day moving average of VIX is still rising, which is not a good thing. But VIX itself has fallen all the way to the moving average. So if it falls below it, that will relieve some negative pressure. It's not necessarily an all-out buy signal. We won't say that VIX is trending down. I mean, obviously, with the 200-day moving average trending up, but the long-term trend of VIX right now is still up. But if VIX falls below that 200-day moving average, that will be somewhat bullish. And then finally, the construct of volatility derivatives, that turned back to bullish a couple of weeks ago and remains there right now. The VIX futures term structure slopes up in the first few months. The CBOE index term structure also slopes upwards. So those are positive signs. So overall, we've got more positive than negative right now, but we don't have that breakout on the S&P chart that I'd like to see in order to confirm all of these things that have been happening over the last couple of weeks. I mean, we have had a tremendous oversold rally, but these have been known to fade in bear markets. And so I'd really like to see a close above 4,600 before I went all in on the bullish case. I invite you to visit our website, take a look at our newsletters where we follow these things daily. And meanwhile, have a great week trading.